This is Anthony Galliano for B2B Cambodia with a tariff update. Will the Mideast conflict derail the administration's tariff plans? On April 9th, the U.S. administration paused the reciprocal tariffs for 90 days, with the deadline for potential resumption falling on July 8, 2025. The 90-day window was intended to be a period during which countries could urgently negotiate bilateral trade agreements with the United States. In the meantime, the administration imposed baseline tariffs of 10% on most trading partners, with additional specific tariffs on Canada, Mexico, and China. However, there may be a fly in the ointment, to use an idiom, which may be a snag in the administration's plans to impose tariffs after the deadline on July 8th. On June 12th, Israel attacked Iran with strikes involving approximately 200 aircraft targeting over 100 sites. This conflict is escalating by the minute, with both sides exchanging daily, if not frequent, attacks. Before the attack on June 12th, West Texas Intermediate crude oil, a U.S. benchmark for global oil prices, was trading at $68.50 a barrel. The price climbed to U.S. dollars 76.24 a barrel on the day of the attacks, an increase of 11%, before settling around U.S. dollars 73.21 a barrel, up 7% for the day. On April 2nd, the administration proclaimed its Liberation Day to impose tariffs on 90 countries and territories. With the prospect of inflationary tariffs, the administration has had to grapple with campaign promises, which played a big part in the election. On August 9, 2024, there was a promise. Starting on day one, we will end inflation and make America affordable again to bring down the prices of all goods. This was repeated in a rally in August and September, pledging to rapidly drive prices down, covering energy, groceries, electricity, auto costs, housing, and airfares. Regarding energy prices, a pledge at a rally on August 14, 2024 was made to cut energy and electricity prices by 50% within 12 to 18 months. There was a subsequent pledge to get gasoline prices below $2 a gallon. While there is no doubt that tariffs are substantially passed on to the consumer and increase inflation, how does the price of oil impact the U.S. economy? Energy makes up about 7% of the consumer price index known as the CPI. A 10% rise in oil prices may lead to a 0.3 to 0.4 percentage gain in annual inflation, depending on the duration and the pass-through effects. High oil prices often lead to tighter Federal Reserve policy, which affects interest rates, investment, and GDP growth. If oil prices rise, a Federal Reserve interest rate cut may be off the table, and maybe the Fed will increase rates if the spike escalates. So what has history taught us about the correlation of wars, economic shocks to oil prices? In 1973 through 1974, during the Yom Kippur War and Arab embargo, oil prices went from $3 a barrel to $12 a barrel. Inflation increased from 6.2% to 11%. During the Gulf War in 1980, prices went from U.S. $21 a barrel to U.S. $39 a barrel, the CPI climbing from 4.8% to 6.1%. The Iraq War saw prices gradually rise from U.S. $25 a barrel to U.S. $40 a barrel, then $50 a barrel. This happened in 2023. In 2011, during the Libyan Civil War, Brent rose to $120 a barrel. Just recently, in 2022, during the Ukrainian war and subsequent sanctions, the price of oil went from U.S. $95 a barrel to U.S. $130 a barrel, the CPI rising from 7% to 9.1%. If the conflict between Israel and Iran continues or escalates, and if it spreads, oil prices will likely continue their rise, and as history has taught us, inflation will climb accordingly. That begs the question, can the economy absorb both an oil price spike and additional taxes in the form of tariffs, both being inflationary? A short-term scenario is the tariff pause will likely be extended to allow for bilateral trade deal negotiations to continue and to buy more time to see how the Middle East conflict plays out. This has been Anthony Galliano with a tariff update for B2B Cambodia.